we're looking at the market that today is trading on all-time highs. When in the denominator of those valuations, you put 2019 peak profits. So even if next year is full recovery, some of that is priced in. So what we're saying is, look, there may be some upside, but there is some upside. What is important to notice is that at the stock level, there is tremendous upside opportunities, because sitting here today, 20% of the small mid caps in Europe and around the world are still down more than 30% from their highs. And for them to recover, that means they have to go up 50%, and many of them will. And sitting here also, 25% to 30% of the mid caps in the world are trading below book value, which means they're cheaper in the stock market today than in their books.
You talk about these three baskets representing your opportunities: growth havens, diamonds in the rough, and growth shorts. I think we're all trying to find the diamonds in the rough because that obviously represents the best upside on the 21 recovery trade. Who are those companies? Which sectors are they in? Okay. So that's right. A lot of things are going on at the moment. I think in November, there is one thing that happened. That is the one we need to focus on, right? Investor sentiment changed 180 degrees. It went from investors chasing growth at any price to then turning to value. And this is a trade that is going to continue for a very simple reason. Growth has beaten value for the better part of the last 20 years. Valuation dispersion in the market is at a level we've never seen before, excluding the tech bubble, right? And so it's down to those stocks that are still down more than 30%, that have a good balance sheet, good free cash flow generation. They're not going to dilute you via a rights issue, and there's still plenty of upside in them. Things like Bellway, like Arrow Global, DCC, AppPlus, ASTM, Motor Oil, Talgo, FL Smith, right? And if you think about industries, it's about industrials, it's about consumer discretionary, it's about materials.
Eduardo, yeah, plenty of stocks still down more than 30%. I want to just move to the UK because I was pointing out earlier in the show there's been a lot of appetite for UK stocks this week in contrast to what you see across the rest of Europe. And you like the UK at this point. What do you like, and how do you weigh up the Brexit risk that we've been talking about this morning as well?
That's right. That's a great question, Karen. Look, there is risk, right? We don't know what Brexit is what form that's going to take, but I've never seen return without risk. So the point we're making in the report is we're going overweight the UK because it's underperformed this year, because it's one of the cheapest things you can buy in developed markets, because you're looking at a country that has suffered far more from COVID than the continent, and far more than the US, if you look at what has happened to real GDP. And so there is a recovery story here when the world is looking for recovery. As I said, a few things we like there. Arrow Global, Bellway, I think the home builders, these things are down 40% from highs. They're sitting on net cash balance sheets at a time when the world is pricing in full recovery. Seems to be a disconnect to me.